Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to analyze the markets and talk about what's been going on. Alright, first of all, the US dollar index had a pretty nice rally towards the front end of the session, but towards the back end of the session it started pulling back. Markets just had a nice little gap down right after the 10 a.m. open. The main reason why, or the 9:30 a.m. open, whichever one you want to consider, but that point aside, right after the open on the Dow component, something interesting happened. The US dollar index had a pretty nice pullback, but the Italian government bond yields were rising for the most part, but then they started pulling back a little bit. But overall, this kind of just confirmed what I was saying last night in my video. I was anticipating some profit taking from the bond yields right around here on the Italian bonds. Typically what happens if, let's say you bought an Italian bond at, let's say, 7%, and the yields drop down to 6%, that just means people are willing to pay more for a bond regardless of however much yield they're going to get, and therefore the yield tends to drop and the value of the bond tends to go up. Now, for short-term traders in the bond market, this is a perfect opportunity to close down some gains and move their assets out of the bond market, especially in the Italian bonds, and perhaps into more conservative plays, perhaps Japanese treasury bonds. So that's kind of what started off the Euro-US dollar in a weak path. But again, the Euro-US dollar gave it back. It lost a bit, but then it started gaining back whatever it lost towards around 10 a.m. And that's pretty much when the Italian bonds were able to give back some of started to give back some of their gains as well in terms of yield. Yields pulled back a little bit. Let's go back to that day's trading session real quick. And basically, the yield started off a bit strong. They jumped up a little bit, profit taking, and then we started floating back down, I guess. And there was less. I guess there was more demand for the bonds towards the end of it, but overall, because there was some demand for the bonds, the interest rates on the bonds fell a bit, and therefore that caused the Euro-US dollar to have a nice little rally. But again, we're just gonna have to wait and see what the Italian bonds will do. Again, I use the Italian bonds mainly because they're the ones that are the most heavily exposed, and not necessarily as exposed as Greece or Italy. But because the fact that if, let's say, Italy were to go bankrupt, it would have a significant impact on the world economy. And if Greece were to go bankrupt, well, it would have a minor impact on the world economy, and perhaps equity markets would be heavily impacted, but not as much as if Italy were to go bankrupt. So I just want to wait and see how the markets will react. The price premiums on put options are much higher than call options. I already went over that in my previous video. So that means people are anticipating some sort of negative event, and once that negative event is triggered, that's going to cause a rapid pullback and a sell-off in the equities markets. So we want to just watch out for that and be aware and be patient with the markets, because something will come about. Something is bound to happen. And based on how the financial system is structured, I wouldn't be surprised if somebody were to declare insolvency, Greece were to declare it. If so, chances are you would have a bankruptcy case, and bond investors will lose, again, hundreds of billions of dollars in the Grecian and the Irish bond markets. So we're just going to wait and see what happens throughout the year of 2012. But again, Greece and Ireland are beyond help at this point, so I'm not expecting too much from them, but except perhaps some negative news. Now I'm just going to pull back the chart, and I'm just going to draw on the trend line for the Dow component. And as we can see, we are touching multiple areas right here. I'll make sure that I connect the line as much as possible. And basically, we got close to it. I mean, we touched that 20-day moving average, and we kind of retraced back upwards a bit. Basically, we touched it, and that's just typical market behavior. I mean, when you're trading markets, you don't anticipate them to just fall down immediately unless something really negative were to happen. But when markets tend to pull back, it's like the slow float downwards. And again, amateurs, you tend to see that, the trade isn't behaving the way I want it to. But in every major downtrend or in any type of downtrend, you have to be patient. You have to let the trade float and pull back a little bit, even if it's just for a 3 to 5% pullback. That's enough to make some yield off of. So again, that being the case, when you trade markets, you don't just expect stocks to just crash or something like that. I mean, if the data points to it, yeah, but I mean, typically it's going to be something like this. you have to draw in a downtrend, and just kind of remind yourself that, the stocks bounce a little bit, pull back a little bit, and then they bounce a little bit and they pull back a little bit continuously. And the biggest mistake I see amateurs make is that they start to go short, like perhaps right here. Just look very closely at the mouse cursor, and I'll zoom in on the chart a little bit so you get the point. But sometimes, people will get in right here, they'll short, and basically their short is successful for a while, but then you see this quick bounce, and all of a sudden, it puts them at break even, and they get a little nervous, and sometimes, they get sweaty hand and they start, covering their shorts. But as soon as they cover their shorts, the market continues going even lower, and it breaks below that previous low area that they were making maximum profit. They're like, oh shoot, I missed out, maybe I should get in at this point. So they short again, and they short right here. But then the market jumps up again, and it breaks above that area where they previously shorted at, and all of a sudden they're covering their positions again, and they're losing money because it goes against them, because they're like, oh shoot, I'm back at break even, I might lose some money, and all of a sudden the market continues going lower. But then, they decide, oh well, maybe since it broke its previous resistance area, I should start shorting again. So they do. But then all of a sudden the market jumps back up again, it hits their previous area of entry, and boom, they get kicked out of the trade, and then we continue going lower again. So I just want you guys to make that point clear, that if you're new to the markets, know that if you're trading a downtrend, you have to be a little patient. You just can't jump the gun and be, wishy-washy, because that's the last time you want to do it. You want to be patient, you want to remember why you entered a trade, and you want to know what your exit strategy is. Okay, if it's not behaving in a way that you anticipated, fine. Sometimes, but I mean, don't rely on gut instinct until you have years and years of trading experience. Otherwise, a gut instinct is just that, a gut instinct, and a lot of the times it can be wrong unless you have a lot of experience with markets, and then it becomes a lot more internalized, and you have some more discernment as you gain more experience, but not yet. If you're new to the markets, rely on the signals, rely on the indicators, and rely on the fact that in a downtrend, it might pull back a little bit, like today's trading session. We started off with a really strong down day, but all of a sudden we just floated higher. And the main reason why that happened was because on the U.S. dollar index, we had a really strong index, dollar index move, but then we plunged, okay? So we gave back all the gains we made on the dollar index for the day's trading session, and therefore the Dow Jones Industrial Average was able to close right below its day's open. So just keep that in mind. But again, the U.S. dollar index, it wouldn't surprise me if the euro-US dollar were to continue to fall. Okay, going back to the euro-US dollar, it wouldn't be surprising to see it fall just because Italian bond yields were to continue going higher as people are continuing to collect profits off the bond, the profit they make off their bond note itself without the interest rate, or what you would call the coupon rate. So again, U.S. dollar index getting a nice little bounce. Again, we just want to wait and see. It gave back some of their gains. But again, that's typical market behavior. Even in a bounce, you have to be a little patient. It doesn't mean anything quite yet. We want to wait and give it a couple more days. Now, moving on, I want to talk about silver. Silver had a pretty strong day. I mean, the U.S. dollar index pulling back gave the silver market some room to move a little higher, and we're seeing that right now. Again, dollar breaking below the day's open. Therefore, silver is breaking above its day open. Plain and simple. Now, if we look over the longer term chart, I mean, it's still a rounding top pattern. It really doesn't mean anything quite yet. We just want to wait and see. For all we know, silver could continue going a little higher into that 200-day moving average, but it doesn't really mean anything yet because it's not a good opportunity to buy silver. We just want to be a little patient here. Again, yes, you're still in an uptrend. I know that. But, there's perhaps better trading opportunities out there that don't entail as much risk. And that being the case, what are some trading opportunities? Well, Yoku.com is a little overextended on the chart. It was all the way down to around $16, went all the way up to $23. Again, if you think about it, that's around a $7 gain, and near 40-45% upside move in a matter of a couple weeks. Now, considering the scale of the trade, it's lost a lot of value in the past year. It fell down by 80%, but it still moved up by around 40% from the bottom. Again, how we can analyze this is by zooming out a little bit and looking at the volume. Okay, if there's a lot of volume, chances are it's going to go up. If the volume drops, chances are it's going to go a little lower. I think this is a short cover rally. I think a lot of people have been shorting this stock for quite a bit. The main reason why I know this is because whenever you have a lot of volume, it's because it's moving upwards, and that's typically because of a short cover, not because people are suddenly optimistic. Okay, so that just means when you have, let's say you have a lot of, low volume for a prolonged period of time, and the market continues going lower. That just means people are accumulating short positions, and all of a sudden it surges higher because people are covering their positions. Again, the volume drops again because people are accumulating short positions, and boom, it continues going lower. Volume is moderate, but it's not too much, and then all of a sudden it kind of bounces a little bit. Again, a lot of short covering, then it continues going lower again. So again, the way I see this, since a lot of market participants are still short, if there's a lot of volume, chances are it's going to have a jump higher. If the volume drops, chances are it's going to continue going lower, and we just want to watch the macro movements. Again, the macro move is the US dollar index finds some support and it continues going higher. The only way that would work out is if the Italian bond yields were to suddenly rally even further and continue going from 6% to perhaps 6.5% and continue rallying, which again, the options markets, the stock option markets, which we talked about yesterday, are showing that investors anticipate more risk in the near-term future. Therefore, the price of put options are much higher than the price of call options per unit of risk. Therefore, based on what I'm saying, perhaps Youku.com, e-commerce China Ding Ding, and QQ360, they've all had gigantic moves. QQ360 had the smallest of moves from the bottom of 2012 December. I mean, $14 to $17.45. That's around a $3.45 gain. That's around a 25% to 35% gain in a short period of time. E-commerce China Ding Ding moved up from around $4 something all the way to $8.11. That's a 100% gain. And Youku.com has also done something similar at around a 50% gain. Again, these stocks have moved up significantly over a short period of time. Therefore, if there was a significant pullback in the near-term future, chances are these stocks will pull back even faster or more severely than the broader indexes. Therefore, I have to be relatively bearish these Chinese equities because they're a bit overpriced, not really necessarily overpriced, but a little overextended. And if the broader markets were to sell stocks, chances are these would be sold first. And since these would be sold first, you would lose a lot of money. Therefore, I would have to short QQ360, e-commerce China Ding Ding, and Youku.com. Okay, so let's just be patient. I saw an up move, in a couple of these equities. Some just pulled back, but we're just going to wait and see how much room there is for these to pull back. I think there's a lot of room for the downside, and we're just going to wait for the macro moves to play out. Okay, take care, folks. If you have any questions, leave a comment right below on my video. See ya.